myself, Michael Roberts. This particular Zoom webinar is going to be about the nature of profitability in the modern capitalist economy and perhaps its relation to the current COVID pandemic. In order to discuss that issue, I'm very happy to welcome Brian Green to discuss with me some of the things that he's been working on, and so you, the viewers, can find out more about it. Brian has been a trade unionist for decades in the labour movement and a Marxist and activist in various labour movements. And more recently, he's concentrated on producing a blog, which is called theplanningmotive.com. We'll put that up on screen later to make sure people are aware of it, in which he developed some very innovative ideas about the nature of the law of profitability as Marx sees it, the so-called transformation problem, and questions about the nature of measuring profitability in a Marxist sense under capital, the turnover, and various other aspects involved. And he's got some new and interesting ideas to present to us in the immediate situation in relation to the pandemic. So I'm going to ask Brian now to come and give us a bit of an intro into what he's been doing and the things that he can present to the viewers, and then we'll have a bit of discussion.
Am I on?
You're on, Brian.
Right, I'd like to begin to thank you, Michael, for arranging this Zoom event. There can be no more important discussion than the one we are embarking on, perspectives for the world economy on exiting the lockdown. We all recall the vivid pictures of temperature testing at airports and other public areas when the pandemic broke. In a desperate attempt to capture those contagious, they used those temperature, the thermal cameras. Similarly with capitalism, its temperature is the rate of profit because it alone can determine whether the economy is sick or not. The only requirement for assessing the future is to first comprehend the past. Thus, our starting point has to be the rate of profit as it presented immediately before the pandemic or plague. Both Michael and I are adamant that profit determines investment and not the other way around. The cart does not lead the horse. The operative rate of profit, that is the one that informs investment decisions, is the enterprise rate of profit. I use pre-tax and unadjusted non-financial corporate profits as the biggest body of uncontaminated profits in the economy, and these are derived from NIPA table 1.14. It is then divided by fixed and circulating capital. I believe this rate of profit to be the operative rate and not the rate of return which excludes circulating capital. I do not wish to dwell too much on the subject of circulating capital, having suggested to Michael that we organize a future panel to debate the method which best describes the rate of profit and that is closest to Marx's idea of the rate of profit. Right, I'd like to kick off in graph 1. This is a relationship between the amount of circulating capital in each year versus the amount of the value of fixed capital. So it's a simple ratio, one of the other. Now, if you look at the 10 years, this is a 20-year perspective. So if you look at the first 10 years from 1997 to 2008, you see that there is a very sharp fall in circulating capital as a share of fixed capital. That's what we would expect. It falls from 38% to 30%, almost by a fifth. Now, Michael has drawn a lot of attention to the fall in the rate of fixed investment post the financial crisis. What hasn't been seen is the ratio, what's been happening to circulating capital. Anecdotally, we've seen, for example, that there's been an increase in employment of workers. Allegedly, there's full employment in the United States. But what we see in this graph very, very uniquely is that circulating capital stops falling and it even rises by 1%. And this obviously means that one of the countervailing influences on the fall in the rate of profit is absent, because circulating capital should necessarily decrease as fixed capital substitutes for labor, but in this case it hasn't done so. We can now turn to look at the rate of profit we can now look at the rate of profit in the United States. Now, for me, the important rate of profit is the enterprise rate of profit, which alone will tell a capitalist whether or not it's profitable to invest, as opposed to, for example, the net surplus, which is a much bigger figure, which includes interest paid and all kinds of different things, rents. So let's turn now to the observe is how much lower it is than the normal rate of profit. That's because it includes circulating capital as well. And currently that rate of profit is trending around the 4 to 5%, or the middle of 4 to 5%. But interestingly enough, and something that you, Michael, have commented on as well, is that the fall since 2014 has been unbroken, and it's gone for 5 years. In fact, it'll be going for 6 years, because this year the rate of profit will collapse to close to zero. And for that not to have precipitated a recession is very, very unusual. I call the last quarter, first quarter 2016, a pseudo recession, one which was salvaged by the Fed through interest rates. But we can see that this is a sustained fall in the rate of profit. At 4.5%, it's just above the cost of capital. It's also an average, which means given the unevenness that we find in capitalist economies, a lot of zombie, what Michael likes to refer to, a lot of zombie corporations are out there where they're barely covering, if they are covering, the actual cost of capital. So from the temperature of capitalism, we can see that quite clearly capitalism's suffering from a bit of hypothermia. Now, how has it been possible that with such a subdued rate of investment that economies have grown? In fact, the link between the rate of profit and investment is actually there. In 2019, when we look at global statistics, we see that investment fell, production stagnated, and we also found that international trade fell. So all the things you would expect from a low rate of profit at a time when profits and investments have been declining. The answer is the bubble economy. It's been the capital gains which have fed into personal consumption expenditures. On the work I've done on my site, I attribute 70% of the increase in personal consumption expenditures in the United States, which drove GDP, to have emanated from capital gains. So what I've developed as well is a graph, which we can now look at, which is graph 3. And graph 3 is what I would consider to be the closest thing to actually plotting what is a bubble economy. Okay, so I've used the same unadjusted profits for both the price to equity and the rate of profit. So the real multiple is the rate of profit turned upside down, so that it's capital over profit, and that's the red line. And the P to E ratio is trailing using the same profit figures. And we notice that throughout this 50-odd years, up until the mid-1990s, the blue line, the P to E, is below the red line. And this is what I would consider to be a healthy arrangement, because obviously not all profits can be paid out in dividends, so price to equities should fall below the real rate of profit, the profit multiple, because some of that profit has to be held back, some of it will go to extra investment, some will be put aside for contingencies such as pensions and so on and so forth. But we noticed that after 1996, these ratios invert. And in the run-up to the bubble economy, we see the blue graph overtaking the red graph. Now, for our purposes, we are looking at 2013 onwards. And what we see is that from 2013, the blue graph again overtakes the red graph. So for 6 years, we have been in bubble territory, courtesy of the Fed easy money. And I think it's very important to realize and to remember what Marx said, that low rates of interest, what he called almost free money, always spurs speculation, just as gluttony is fed by pork, and and that capitalism was being driven by an unhealthy situation. Instead of the economy being driven by rising profitability feeding into rising investment, it was really being driven by falling interest rates and that feeding into speculative gains. As that's my last graph.
Well, thank you, Brian. It was a very interesting discussion on all points. So if I come up to the beginning, there's the global position as I've calculated it using the Penn World Tables 9.1. There's a series in there that's new. It's called the internal rate of return on capital. As Brian has pointed out, of course, that doesn't cover circulating capital, or for that matter, all parts of circulating capital, whether the variable part from labour power or raw materials and inventories. But nevertheless, it gives us an indication of the trend on any country you can find, therefore a strong support for Marx's law of profitability, then the so-called neoliberal recovery, and now what I call a depressed period for profitability since the late 1990s and into this 21st century. And more closely, we can see in the last 20 years, the global corporate profits, which is a weighted mean of the major economies' corporate profits figures, not non-financial, but all of it, you can see that the rate of growth of corporate profits on a weighted basis for the major economies has been trending downwards with ups and downs in there. But more importantly for our discussion, just before this virus broke, it actually had reached almost or actually at zero, and some countries below zero in terms of growth of profits. So the capitalist economy in the major economies was already weak before this virus broke. That's an important thing to be aware of, that the shock of the virus isn't the only reason, or the fundamental reason, you might argue, for the global slump that we're now entering. Maybe the depth can be laid at the door of lockdowns and the closure of production and investment, but the likelihood of a slump in 2020 was very high anyway. And as Brian has said, we agree on the fact that it is profits that lead investment and not the other way around. That's crucial for us to understand. And a very recent paper by two economists based at, would you believe, the Cranfield Institute of Management, where they argue, looking at multiple variant regressions of recessions against possible determining variables, they find that the most highest confidence and positive correlation is between falling profitability and the probability of recessions, looking back over the last 50 or 60 years at various periods of recession and what was happening to profitability, measured somewhat similar to the graphs I just said before. So, and they then looked at alternative determinant variables like private credit, interest rates, or the movement of the stock market relative to the level of value in fixed capital, which is called Tobin's Q. Interestingly, Brian has come up with a much better way of measuring that relative difference between the level of market capitalization in the stock market and the real level of capital in productive sectors. But all those determinants turned out to have very little significant correlation with the probability of a recession. Falling profitability was the crucial factor as far as these authors were concerned. I just bring that up as a new paper because there's been loads of papers actually which confirm that relation over the last 10 or 15 years. Ignored, of course, by mainstream economists on the whole, and ignored often by left-wing and left Keynesian economists who continue to consider the other factors, which are cited by Alexou and Trakanas: private credit, interest rates, the stock market, in other words, the financial aspects of the capitalist economy are more important in analysing the probability of recession. But that's not true. Marx's fundamental law of the tendency of the rate of profit to fall and its implementation in modern capitalist economies remains the most important factor. If I come out of here, we can have a brief discussion, I think, on in our available time now to see whether there's anything else we want to add in relation to what we've discussed so far, Brian. So I presented a more global, short global analysis to what you've been saying. You presented a whole new series of other points relative to your important measurements that you presented. But is there anything else you want to say to our potential viewers about this aspect and what it means for understanding what's happening in the pandemic now?
I think, Michael, one of the things we need to really discuss, you talking about the global perspective. In my view, this fall in the international rate of profit from around 2014, and especially when you look at the flows of capital changing leading up to 2016, I think this international fall in the rate of profit actually marked the end of the phase of globalization as we understand it. And you know, in the last 72 hours, we've seen the United States threatening China in ways it hasn't threatened China before. But I believe that capital became aware that globalization wasn't delivering the goods from around in the period 2014 to 2016. Now, in terms of our perspectives, nothing could be more important than that. Because if they're going to restructure global chains, that's an expensive business and it adds cost to a global economy that's already suffering from falling profit margins. So that's yet another obstacle, another barrier to the world economy coming out of this pandemic. I don't know, what are your thoughts on that?
I think you're right that we have the global value chain is severely disrupted. World Trade Organization reckons that world trade will be falling by something between 10 and 13% this year. The value chain is disrupted in the sense, take China that's so supposedly recovering now from the pandemic. Its manufacturing indexes are showing only a moderate improvement, and the reason is, even if manufacturing comes back up to scratch in China, there is no export potential at the moment with everybody else locked down. And also the value chains are disrupted, so it's going to be very difficult to reorganize the distribution of parts and other things that flow into producing the final product to the consumer or to other businesses internationally. Also, there is now clearly an attempt on the part of the US and other governments to try and restrict the ability of China to develop its markets by reducing its sourcing into China, looking for alternatives and so on. So there's going to be a very interesting development on the trade front and on the value chain front, which can only be detrimental to the profitability globally for capitalism if there's going to be a restriction of trade, a disruption of value chain, and an attempt to nationalize what used to be an important global value chain for capitalism over the last 30 or 40 years. Do you agree with that, Brian? Or?
Yeah, I do. And you see, this is what we are investigating, how boxed in capitalism is at the moment. So globalization is fracturing. Rate of profit is on its knees. Global investment is, and the flows of direct investment are virtually non-existent. So when you look at what could possibly resuscitate capitalism? You know, what ventilator? The only ventilator that's pumping anything out is cheap money. I mean, the amounts of money is huge, Michael. You must have seen in the last few days that the Treasury in the United States is expecting to have to issue $4.8 trillion worth of bonds this year, which is about 22, 23% of GDP, the US GDP. And I'm telling you, that's an underestimate because they are assuming bounce back in the second half.
Yeah.
You know, we're talking about damage to the world economy that exceeds the Great Depression, and which is much more intense and much more concentrated. Obviously, when we look at the total damage, it's depth times duration. But if we exclude duration for the time being in terms of an acute failure of the world economy, this is the worst that capitalism has ever had to endure in the modern sense, in the modern setting. And I just can't see how they are going to revive profitable production. There just isn't anything there that can breathe life into the capitalist economy except in cheap money. And even that has its limitations.
Well, I think that's where we're going to have to leave it, guys, because Zoom is rather restrictive on how much time we've got. And I think Brian has covered a lot of points for all the viewers to consider. We'll probably come back and do some more of these in the future. This is our first attempt to see if we can draw out some of the ideas visually and not always just through documents and so on. So edit it up. We'll have all the references that you've mentioned, Brian, so that people can get to your blog, The Planning Motive, and get an opportunity to look at the documents you've got there, not just the work you've done in this particular session, but on the other works. And we can definitely be coming back to discuss this again. Anyway, thanks a lot both to myself and to Brian, and we'll be talking to you again. Thank you, Brian.